All right, so talking about next year, just since you referenced it, Lori Calvasina from RBC out with a 5,000 target for the S&P for next year. Just want to mention it because you talked about it. But I want to stay on the current situation right now with you, Jim. What's your take on what you're seeing? Again, we saw bond yields go down to a 2-month low, 4.36, bouncing back up a bit.
I feel like a lot of people I talk to want me to get worried about the situation. And I really appreciate the positivity from my colleagues. But, you know, a lot of people want to talk to me again about the yield curve. Like, honestly, I think I'm done talking about the yield curve. Let's just leave that aside. Or they want to talk about durable goods orders disappointing today. Or maybe Deere's guidance, which we'll get to later. Or Cisco's guidance last week. And I really think the point is being missed both in the microscopic and the big picture. The microscopic, let's just do that right now. Jobless claims. We were supposed to get worried last week when they popped, and now they're right back down to where they've been hanging out, right around 200,000. And that is very important, folks. If people are employed, they're going to consume. Consumption is 70% of this economy. I get it about consumer delinquencies. I get it, okay, about running out of savings. But here's the bigger point, is that let's just say I'm wrong. Let's dance with this idea for a second. Joe got very excited there. It's like he's going to dance with me on this. No,
I'm actually very calm, but
your eyebrows raised. For you, that's very exciting.
I'm trying to stay awake while you're talking.
Let's take it down a notch, guys. Let's take it. It's not a Comedy Central roast. It's the day before Thanksgiving.
That was good. Here we go. Let's just say that I'm wrong and that there is a slowdown that's occurring right now that's bigger than I expected. Let's just say I'm wrong about the economy skating through there. You know, it is likely to be short and sweet if there's a slowdown. These guidances that we haven't liked, I mean, the fact that next year's earnings estimates have come down as the third quarter results have gone up.
Barely.
Okay, but they certainly haven't integrated the excellent third quarter results. Look, people are still thinking this is going to be some clear the forest floor fire. But all the imbalances are out, right? All the crypto, NFT, meme, SPAC stuff, that was done 2 years ago. You don't have a housing boom. You don't have a tech telecom boom. There's no overgrowth in terms of investment that needs to be cleared out with some brutal recession.
So wait, Jim.
If we're in that slowdown, Frank,
right? That you're not worried about, to be clear.
It's likely to be done really quickly.
Yeah, we are getting a revision of third quarter GDP next week, so that's something to watch. You mentioned the slowdown. We'll talk about it a little bit later in the show. But Joe, I know you want to jump. You're trying to stay awake while Jim's talking. I just wanted to come off your one-liner. That was a good liner.
No, but I think the premise that you have is that the fundamentals of the economy are strong, but I'm not sure that's the catalyst behind why the market's rallying right now.
It's bond yields.
And I think, I think when you turn the calendar into January, I don't know if that is going to be the thesis that the economy is overwhelmingly strong and we could take the handoff from a nice Q4 rally into Q1 of next year. I think it has to be that the Federal Reserve sits with their hands, doing nothing, and that the economy shows the signs that it's showing right now, Jimmy, where I disagree with you somewhat, where yes, in fact, the consumer is more cost conscious. And in fact, it does look like we're seeing a little bit of deceleration in the economy. And I think that's a good thing.